Three of the most powerful institutions on the planet made the exact same decision in the same 7 days, and the last of them came down this past Thursday. On Wednesday, March 18th, the Federal Reserve voted 11-1 to hold rates steady, keeping them right where they have sat since December. 24 hours later, the European Central Bank held at 2%. On the same Thursday, the Bank of England held at 3.75%. 9 votes, all of them to hold. The first unanimous decision the Bank of England has delivered since 2021. 3 central banks, 1 week, 0 movement. Central banks are not supposed to move in lockstep. They have different economies, different mandates, different political pressures. When all 3 freeze at once, something bigger than any one of them is in control. It is in control of your money too. What has them cornered is a combination of forces that monetary policy was not designed to fight simultaneously. Inflation stuck above target while the economy barely grows and jobs disappear all at once. In the United States, the economy grew at just 0.7% in the fourth quarter of 2025, barely above zero. The month before the Fed met, the economy lost 92,000 jobs, and yet inflation, as measured by the Fed's preferred gauge, is running at 3.1%. That is a full percentage point above the Fed's 2% target, not barely above, a full point above. This is the trap that has a name nobody wants to say out loud. Stagflation is the word. It means high prices and a weak economy at the same time. The reason central bankers hate that word is that it describes a situation their primary tool cannot fix. Think of interest rates as a single dial, one dial. 2 problems. You turn it up to cool inflation, you freeze the jobs market. You turn it down to restart growth, you pour fuel on the fire. There is no version of this where the interest rate lever fixes both sides of the problem at once. The only question is which side you let bleed. That question is inside your household right now. The Iran war triggered the current episode, but it did not create the conditions for it. The Strait of Hormuz closure sent Brent crude past triple digits. That pushed U.S. gasoline to $3.85 nationally, and it is heading higher. Oil does not stop at the pump. It reprices everything. It touches the truck that moves your food, the factory that makes your goods, the farm that grows your groceries. By the time the war hit, inflation was already refusing to come down. The war just slammed the door shut. The ECB raised its inflation forecast for 2026 from 1.9% in December to 2.6% in March. In their own severe scenario, Eurozone inflation peaks at 6.3% in the first quarter of 2027. Which is how 3 central banks ended up making the same choice in the same week. But the real question is not why they froze. It is whether the word nobody wants to say out loud actually applies this time. 9 times out of 10, when the word stagflation gets thrown around after an oil spike and a growth wobble, it is wrong. This time, it is not. Here is what makes this moment different from every other inflation scare of the past decade. After the pandemic, inflation ran hot because people had money and nowhere to spend it for a year, and then suddenly everywhere at once. Too much cash, not enough stuff. Prices went up because demand was the problem. And demand is exactly what interest rates are built to crush. Raise rates, cool spending, prices fall. It worked. Slowly, painfully, but it worked. What is happening now is structurally different. The inflation arriving from the Strait of Hormuz is not demand inflation. Nobody decided to suddenly want more oil. Nobody chose to push crude past $100 a barrel. A military conflict choked a choke point that handles roughly 20% of all global petroleum exports, and prices moved because supply collapsed, not because demand accelerated. That distinction matters more than almost anything else you will hear about the economy this year. Supply-side inflation does not care about interest rates. 20% of global petroleum vanished from the market. You cannot replace that with a rate hike. You cannot reopen the Strait of Hormuz by raising the federal funds rate. All you can do is slow demand enough that people buy less of everything, including the things that have nothing to do with oil, until the overall price level drops. The cure is a recession, and even then, the shortage is still there. You just made everyone too broke to buy as much of it. That is stagflation, and it is categorically worse than a normal recession. In a normal recession, the central bank cuts rates and the economy comes back. Demand was the problem. Lower rates fix demand. In stagflation, the bank cuts rates and growth still struggles because the supply shock is still there. Cheaper money just means more cash chasing the same shortage. Prices go up faster. You are not choosing between 2 bad options. You are choosing which way to make things worse. The numbers confirm the trap is already active. US GDP at 0.7% in the fourth quarter of 2025. 92,000 jobs lost in February. And core PCE inflation, the Fed's preferred measure, at 3.1% in January, before the energy shock from the Iran war had even fully registered in the data. The inflation you are seeing right now is the pre-war number. The post-war numbers have not arrived yet. The ECB's economists ran the math on what happens if the energy shock is severe and prolonged. Their baseline scenario, the optimistic one, has Eurozone inflation averaging 2.6% through 2026. Their worst case, inflation peaking at 6.3% in the first quarter of 2027. That is 3 times the ECB's target. Not a little above target, 3 times the target. And growth? The ECB now expects Eurozone GDP growth of just 0.9% in 2026, the same year they may need to hike rates to contain the inflation. Less growth, higher rates, more expensive everything. Now bring it home. There is a number called the misery index. It is simple unemployment plus inflation. Right now in the United States, it sits at roughly 7%. That is not 1970s territory. The 1970s peaked at over 20%, but the direction of travel is what central bankers are watching. A year ago, these numbers were moving the right way. Now they have reversed. And a reversal, if it gains momentum, is very hard to stop without doing something painful. What that painful thing is, and why every central banker alive is desperate to avoid it, is the story from more than half a century ago that still runs monetary policy today. In 1970, Arthur Burns became chairman of the Federal Reserve. He was one of the most respected economists in America, a Columbia professor, a former chair of the Council of Economic Advisors, a man who had studied business cycles his entire career. He knew exactly what inflation was. He knew exactly how central banks were supposed to fight it. And then, when the moment came, he did not fight it. What Burns did instead has a name in monetary history: stop-go policy. When inflation rose, he raised rates briefly. When the economy slowed and unemployment ticked up, he cut them again. Every reversal taught the market the same lesson. The pain was temporary, and the Fed would always back down. Inflation rose further. He raised again. The economy weakened. He cut again. Each cycle left inflation a little higher than before. Each retreat told businesses and workers the same thing. The Fed will blink. Build your wage demands accordingly. Price your contracts accordingly. Inflation is permanent plan for it. By the time Burns left office in 1978, inflation was averaging 9% a year across his entire tenure. The Arab oil embargo of 1973 made it worse, but the embargo was the accelerant. Burns had already built the fire. The bill came due. What followed was one of the most brutal episodes in American economic history. Paul Volcker took over the Fed in 1979 with a single mandate he gave himself: break the inflation psychology, whatever the cost. He raised the federal funds rate to 20.06% in January of 1981, 20%. The economy went into recession twice. Unemployment climbed above 10% for 10 consecutive months. Farmers drove tractors to the steps of the Federal Reserve building in Washington in protest. Car dealers mailed coffins containing the keys of unsold vehicles to Volcker's office. It worked. But it took nearly 3 years of deliberate economic destruction to undo what 8 years of stop-go policy had embedded. That is the story every central banker alive has memorized, not as history, as a warning. When Jerome Powell stood at the podium on March 18th and pushed back on the word stagflation, he was not making an economic argument. He was making a credibility argument. He said the 1970s saw unemployment in double figures and inflation really high, and that is not where we are. He is right about the numbers. But the reason he reached for that comparison immediately, without being asked directly, is that the comparison lives inside the institution. The Fed does not just remember Burns. The Fed is organized around never being Burns again. This is the hidden mechanism behind the freeze. Central banks are not holding rates because they are confused. They are holding rates because the one thing more dangerous than a weak economy is a central bank that loses its credibility on inflation. A central bank that loses credibility has to become Volcker to get it back. And becoming Volcker means deliberately engineering years of pain, unemployment, recession, collapsed asset prices just to prove the institution means what it says. The ECB held, the Bank of England held, the Fed held, not because they do not know what is happening, because they know exactly what happened the last time a central bank pretended it did not have to choose. This is why the freeze is not a failure of nerve. It is a calculated bet that tolerating economic pain today is cheaper than losing credibility and paying Volcker prices tomorrow. Whether that bet is right depends entirely on how long the energy shock lasts, and that answer is not in Frankfurt or London or Washington. It is in the Strait of Hormuz. It is not coming. It is already here in the price you paid this morning without thinking about it. Start with energy, because everything else flows from it. Brent crude is trading above $100 a barrel. U.S. gasoline nationally is at $3.85, headed toward $4.25. That gap from where prices are now to where they are heading is not a prediction. It is already in the futures market. Diesel moves freight, freight moves food, and by the time that food reaches your table, it has been marked up at every stop along the way. The 30-year fixed mortgage rate hit 6.22% the week of March 19th. That is up from 5.98% on February 26th, 24 basis points in 3 weeks. The cause is not the Fed moving rates. The Fed held. The cause is the bond market pricing in the possibility that the Fed cannot cut and may eventually have to hike. When traders believe rates are going up, long-term yields rise and mortgage rates follow. The freeze at the Fed is doing more damage to the housing market than a rate hike would, because at least a hike would signal the problem is being addressed. The freeze signals nothing except uncertainty, and markets price uncertainty expensively. If you are not borrowing, if you are holding cash in a high-yield savings account, you are earning somewhere around 4 to 4.5% annually. Inflation on the things you actually buy, groceries, fuel, utilities, is running above that. Your savings account is open. Your purchasing power is quietly leaving through it. You are not losing money on paper. You are losing it in the supermarket. For anyone carrying a variable rate loan, credit card debt, adjustable rate mortgage, home equity line, the federal funds rate has sat at 3.5 to 3.75% since December. Rates have not moved, which sounds like good news. It is not. Rates staying high for longer is the same as rates going higher, stretched across more time. Every month the freeze holds is another month of elevated cost on borrowed money, and it is not just America. The ECB's own economists, in their severe scenario, project Eurozone inflation peaking above 6% in early 2027. The Bank of England projects UK consumer price inflation above 3% for much of this year. And in the United States, core inflation is already above 3% before the post-war energy data has fully arrived in the official numbers. What you are paying now is the floor, not the ceiling. The misery index unemployment plus inflation sits at roughly 7% in the United States right now. That number does not capture the full picture. It uses headline unemployment, which counts only people actively looking for work. The economy feels worse than the headline number suggests, because it is worse than the headline number suggests. The broader measure, the one that counts discouraged workers and people stuck in part-time jobs who want full-time, ran nearly double the official rate in February. And the freeze guarantees it stays this way. So when does it end and how? Here is what the market currently believes will happen. One rate cut, 25 basis points, sometime in December. That is it, the entire expected path of Federal Reserve policy for the rest of 2026, compressed into a quarter-point move at the very end of the year. 2 months ago, markets were pricing 2 cuts. Before the Iran war, they were pricing a first cut in June. That June cut is now priced for September at the earliest, and the probability of 0 cuts this year has risen to nearly 20%, up from almost nothing in January. Jerome Powell did not rule out a rate hike. He said it at the March 18th press conference carefully and deliberately. The possibility that the next move might be an increase came up at the meeting. Not as the base case, but on the table. A Fed that was cutting 3 months ago is now openly discussing whether the next move is up. That is not a subtle shift. That is the entire rate cycle reversing direction in a single quarter. The ECB is further along in that reversal. Traders are now pricing 3 quarter-point hikes from the ECB before year-end 75 basis points of tightening in an economy growing at less than 1%. Barclays and JP Morgan have penciled in increases at the April, June, and July meetings. An ECB that was cutting rates just months ago is now being priced by markets to hike 3 times before the year is out. The Bank of England is in the same position. Markets priced nearly 40 basis points of tightening by year-end in the days following the March 19th decision. The Bank of England's own meeting notes made one thing explicit. The longer energy prices stay elevated, the deeper the risk that higher costs embed into wages and never come back down. So, what actually breaks the freeze? There are 3 paths. The first is resolution. the Strait of Hormuz reopens, oil falls, inflation pressures ease, and central banks resume cutting. This is the base case. Yardeni research still assigns 60% probability, the scenario where the energy shock proves temporary. If oil is back below $80 by summer, the freeze thaws on its own. The second is escalation. The conflict deepens. Oil stays above $100 through the second half of the year. Inflation embeds into wages, and central banks are forced to hike. This is the path that ends with a recession deliberately engineered, Volcker style, to break inflation expectations before they become permanent. Yardeni puts the probability of this scenario at 35%. The third path is the worst one, and the least discussed. The conflict neither resolves nor escalates. It simply continues at its current level, keeping oil elevated, keeping inflation above target, keeping growth suppressed, and keeping central banks frozen. Not moving up, not moving down, just suspended. Month after month of the same impossible choice, with the economic damage accumulating quietly in the background while everyone waits for a clarity that does not arrive. That third path has no clean ending. The 1970s took a full decade and a 20% federal funds rate to resolve. This time there is no Volcker waiting in the wings, just costs, rising slowly, spread unevenly, landing hardest on the people with the least buffer. Not on the institution, not on the boardroom, on the person trying to make the numbers work at the end of the month. So here is where you actually are right now. 3 central banks are frozen. The inflation fighting the freeze is not demand inflation. It cannot be rate cured without destroying growth first. And the bill for all of it, for the oil shock, for the frozen rates, for the wait and see, is being paid right now in increments by the people who can least afford the wait. Your mortgage rate is higher than it was 3 weeks ago. Your gas is more expensive than it was 3 months ago. Your groceries cost more than they did a year ago. And the institution with the most power to address any of this has decided, rationally and deliberately, that protecting its own credibility matters more than moving right now. That is not a conspiracy. That is not incompetence. That is the system working exactly as it was designed to protect the long-term integrity of money, even when the short-term cost lands on you. Understanding that does not make the cost disappear. Your mortgage rate is still north of 6%. But it changes what you are looking at. You are not watching a group of confused officials fumbling through an unprecedented crisis. You are watching institutions that know exactly what they are doing, making a calculated bet that the pain of waiting is less than the pain of moving wrong, and hoping the Strait of Hormuz gives them the answer before the economy forces their hand. The numbers are moving in the wrong direction and they know it. The post-war inflation numbers have not arrived yet. The next Fed decision is April 28th. Between now and then, every data point, every jobs report, every PCE reading, every oil price tick is either evidence that the bet is paying off or evidence that the freeze is becoming the problem it was designed to prevent. Watch the data. That is where the answer is, before you go one more thing worth knowing. Everything we just covered describes a macro mechanism. But mechanisms have personal consequences, and those consequences land differently depending on what you own, what you owe, and what you are planning to do with your money in the next 12 to 36 months. This is not personal financial advice. What follows is a framework the same kind a trained analyst would use to think through the environment we just described. Every situation is different. Your specific decisions should involve a professional who knows your full picture. With that said, here is what the historical record shows about stagflationary environments and the assets ordinary people actually hold. Real estate with a fixed-rate mortgage has historically been one of the more resilient positions in supply-driven inflation episodes. According to Federal Reserve historical data, homeowners with locked-in rates effectively saw their real debt burden shrink as inflation eroded the value of the dollars they owed. If you already have a fixed-rate mortgage, the inflation component of this environment may be working in your favor. If you are considering buying, current rates reflect a market that is not pricing in relief anytime soon. That calculus changes if the energy shock resolves. Cash and short-term savings accounts are losing purchasing power in real terms right now. The BIS and Federal Reserve research on historical stagflation episodes consistently shows that cash underperforms during sustained above-target inflation. The opportunity cost of holding large idle cash balances is measurable and rising. Gold has historically preserved purchasing power through supply-driven inflation episodes, according to World Gold Council data going back to the 1970s oil shocks. It is not a growth asset, it is a stability asset, and its role in a portfolio is specific to that function. Index funds and broad equity ETFs face a more complicated picture. The IMF's research on past stagflation periods shows equity returns were highly variable energy and commodity sectors outperformed significantly while rate-sensitive sectors underperformed. The composition of your exposure matters more than the headline index number. The central question for your own situation is not which of the three paths resolves this. It is whether your current position can absorb a prolonged freeze without forcing decisions you did not plan to make.